What?
So close to 4,500, but now we're a good 30 handles away. A double top, or the Spoos is getting a running start into that area. A little bit more work to do today. We got some stocks moving here. It's a Wednesday. It's pre-market prep. Kind of feels like a Thursday with the holiday. But let's get it started, Mitch.
Coming to you live from downtown Detroit, this is Benzinga's Pre-Market Prep with your hosts, Joel Elconin
This is a volatile puppy here, isn't it?
and Dennis Dick,
I'm bidding a penny. I'd buy that stock for a penny.
with everything you need to start your trading day.
All right, traders and investors, we got a little red on the screen here. Overseas markets in the red. We're in the red by 23 handles, 46.6750. And that's the low of the session. The buck is up 19 cents at 102.84. Bonds down again. Bonds are telling us, man, there's more rates coming. Crude up 40 cents at 71.40, trying to get through that major resistance just above 72. Gold flat here basically at 1934. Silver really flat at 22.97. Bitcoin futures, they're down $455 at 30,635. Triple D, what is weighing on the index futures this morning, in your opinion?
Overseas markets. I mean, we were closed yesterday, but they were open basically everywhere else. Europe was down, China was down. You got a little spillover effect here in our markets, a little catch up trade because we had the nice holiday, but while we were relaxing on the beach or breathing in our smoke, if you're up in our area, the other people were selling stocks. So, little catch up trade here this morning.
All right, little catch-up trade. Good morning, Mitch. Let's bring you in here, and
Yeah.
we got some movers here on this Wednesday. Does it feel like a Wednesday? Does it feel like a Thursday? Does it feel like a Monday? I mean, having that holiday on a
I don't know,
Tuesday
man. It
here.
feels just weird.
I'm
can't
ready
figure
for
out
the
what day
Friday
it is.
already. Can it just be Friday? Let's
I
just make
can't
it
figure out
Friday,
the
right?
day.
All right.
You-
Well, investors today are definitely going to be eagerly awaiting the Federal Reserve's minutes from June, set to be released at 2 p.m. today. Of course, these minutes could provide valuable insights into the future path of interest rate hikes. In addition to that, look out for New York Fed President John Williams is expected to address the Central Bank Research Association at its annual meeting in New York City at 4 p.m. Eastern. So stay tuned for any updates from these events.
I guess I'll go first here, and I'll just
Sure.
say I thought it was a hawkish pause. I mean, they did pause. Dennis, you alluded to in the pre-market show, you still see prices going up. I mean, is it
There,
a foregone conclusion that we've whooped inflation and that rates are all of a
I think they're
sudden?
just cooking the books more, to be honest. I think that, and I do think this occurs. I do think that they take out stuff that's inflationary in the index. I do think that people have selective perception, and if they want to see a deflationary story, they'll find stuff that has come down. We know some commodity prices have come down. We've talked about lumber coming down. We've talked about oil coming down. There's a lot of little things going up, though, and I'll tell you what is not coming down is labor. And housing prices have come down in a little bit in where my area is, but they're starting to tick back higher here too. So I don't feel like inflation is beaten at all. I feel like it's a little lull. I think the Fed knows it. I think that's why the Fed is still talking hawkish. I think the Fed speak will still be somewhat hawkish, and maybe that's what's making the markets a little more cautious.
Yeah, they're not getting the desired effect, especially in the housing market and the travel stocks. I mean, people are still spending, and they're spending it at a good clip. So we do get the Fed minutes. I mean, it's hard. You'll see the algos, jumping around on that. But I mean, I think 2/4 point. And if you look at the bond market, I could put the TLT up there. I mean, what is this saying? I guess the TLT doesn't look as bad as the 30-year bond, but man, I mean, this thing has just been in a trading range since the end of May, hanging out at the lower end of the trading range. Major resistance way up there at 34. So I don't know. It'd be interesting to see what the Fed speak is today.
Rates still ticking higher. That's what the TLT is saying. That's what bonds are saying. And they believe the Fed. Where the equity markets maybe are calling the Fed's bluff, the bond markets are not. The bonds aren't taking off. The bonds don't think there's a pause towards the end of the year. The Fed has basically flat out said, no reading the tea leaves, that they have no intentions of cutting rates this year, even though the market still hopes that, we get towards the end of this year, we're going to start seeing rate cuts. I mean, I think we just got to take it at face value. And at a certain point in time, as we continue to go up in interest rates, it does become an attractive alternative to stocks. In my own portfolio, I've stopped buying consumer staples. I've stopped buying dividend yielding stuff, and I'm buying GICs in Ontario, 5.5%. I mean, it's been a lot of years since we could go that high. So that cash portion of your portfolio is performing. Now, again, it's not performing to the tune of the NASDAQ, but we've run a long ways. So is there time to take some profits and some stuff? I think caution here isn't a bad idea. And again, it depends on your overall portfolio and your time frame.
Yeah, of course, we could take a look at the CME Fed tool and see what that's pointing towards. And we could see that's at 86.2% for an interest rate, 25 basis points, and only 13.8% chance of no hike in the next meeting. Of course, this will be interesting. The 26th of July is stated for that Fed meeting. And of course, I think that if you're still thinking that we're going to pivot this year, I think you're definitely not reading the tea leaves, because it clearly doesn't seem like the Fed is even looking into maybe even next year for that pivot. So let alone this year, I think you're definitely getting ahead of it if you think it's going to be
the only
year.
way the Fed starts cutting rates is if the economy falls off a cliff. And
it needs to fall off a cliff, not just go down, stocks go down. No, completely start crumbling, right? Probably financial conditions crumbling, right?
One thing to consider, though, obviously, is that stocks are inflationary. So, I mean, you're looking, at people and saying, well, if inflation is still, running around here and getting us, it's not bad to have some exposure to some stocks, because stock prices can go up in an inflationary environment. They're inflationary in themselves. So, that is a consideration. And it's something like, why, and I was bearish before, but why I was never 100% cash. Because what if you're wrong? So you never like to go all in on anything. And I know people will be like, oh yeah, I'm short this market, I'm 100% cash. There's still an overall 100-year uptrend in the stocks. Maybe the next 100 years aren't going to be up, but I think with inflation, I think with everything else, stocks probably go higher in an inflationary environment too. But we just know the Fed's still there. We've had a pretty good run. I think it's prudent to ring the register on some of the tech stocks. The stuff I've been buying, bought some tech on dips, but you were doing some buying here, Money Mitch. I was doing some buying here too. We're looking, at some value stocks as well. There is some stocks that are trading at attractive multiples. So especially relative to some, 32, 33 times where Microsoft is trying to approach. So I just think, a portfolio rebalancing here isn't a bad idea.
Don't we have a big decision coming up on the Microsoft Activision deal? I think I saw that.
Yes, it's
any day.
Any day. And so that's the only thing about that one. So the trial that's gone by already. So they've all made their arguments. Now it's just up to the judge to determine his answer. And so watch out for that, because when that comes in, definitely going to be some movement. Do you expect more movement in ATVI than Microsoft?
Oh, right? Yeah, Microsoft will move a bit, but it's going to be the ATVI that's really going to move. Again, we know there's $95 price takeout on. If that was to fully get approved, I mean, that's where you're going to be heading. If it doesn't get approved, I've argued here before that I don't think this is going back into the 60s where it was, pre-merger, because we've seen EA and we've seen Take-Two have pretty strong moves here. I mean, Take-Two, $147 here now. So here's an argument that even if it gets killed, the deal, I think ATVI is $77, $78, and I wouldn't be surprised if they come in and buy the dip on that. So I think on dips here, if there's an announcement and ATVI loses $10 off of it, I will be trying to buy the dip on ATVI.
Yeah, that was the only thing I think I disagreed with in the article. They're like, well, I mean, the article made two good points. One is if you've been playing it for
Which
the
article are you
merger,
referring to, first
I
of all,
think it was
Joel?
in Barron's over the weekend.
Okay.
It was in Barron's, and Wednesday I'm still talking about Barron's, but anyways,
What do they say?
they just thought it was going to be really substantially lower. I don't think I remember what the
Yeah.
exact price was, but that was the only thing I looked at it. We looked at it a little bit different because of the way those other stocks rallied, and also, if Microsoft thinks is worth $95, and they're a pretty smart company, and they don't get it, I don't know who else would be out there
Well,
to.
Buffett thinks it's worth more money too, because he still
Yeah.
has it, and he was in it for the risk but he's also said he liked the company. So ATVI PE right now, just trying to get some numbers here.
Yeah.
Forward PE is 20. That's right that's right in there at a market multiple. So let's just comparatively speak on take two, which maybe forward PEs on that's 46.
Ooh,
and again,
double.
forward PEs are a moving target because we don't really know what those earnings are going to be. EA is 19. So I mean, you're right here. I think it's crazy to think that ATVI is going down to the 60s, if the merger gets killed here. I think it'll struggle to get through 74 to 75. I think it's got 8 or 9 points down. And I think you're going to have dip buyers all over the place down there, including me. If ATVI, I'll just say right now, my own long-term portfolio, if I see ATVI go $10 down on the announcement that the deal is dead, I will be buying the stock.
It'll be really cheap.
I will be exactly. It'll be 17 times forward earnings. I will be buying the stock 17, 18 times forward earnings. It's another stock to put in my long-term portfolio. It's a good company. Microsoft likes it. It's going to be a major part in AI as well. These gaming companies, don't kid yourselves, are AI plays. Like, they're going to be major AI plays in the future. So they're not talking about gaming companies AI plays, but common sense says it's going to be all over. In metaverse too. I mean, gaming stocks are not going away. There's the three big guns: EA, Take-Two, ATVI. They've all been pretty darn good stocks. So if a deal goes through, it's $95. If it doesn't go through, I think it dips. But I also think that dip gets bought, and I wouldn't be surprised if it ends up back at 80. So I don't think I think there's downside here, but I don't think it's as much as Barron's thinks.
How about all the reverse ARBs, right? That are saying, no, man, there's no way this deal is, because there's been a lot of news coming out, and they're just getting jammed here. That maybe having a short position or having the spread on a different way. They're praying. They're praying that this thing doesn't, and if it does, they're not going to get any better bad news than that. The deal not going through if they look to buy the dip. I don't know how many people are going to be short something, at 78, 80 when there's a $95 takeout on there. But we'll see. When it hits the tape, it'll be interesting to see whether it's during the trading day or after hours, or they'll pull a halt or something. So just be aware, if you've been playing for the merger, you've been buying the stock the whole way up. It's decision day coming real soon.
I hope it dips $10 because I'm licking my chops trying to get some ATVI back at $74.
Okay.
That sounds pretty good to me.
All right, let's go to UPS, as the Teamster Union, representing around 340,000 workers at the United Parcel Service, has stated that the parcel delivery company has walked away from negotiations over a new contract. This raises the possibility of a strike at the current contract covering UPS employees expires on July 31st. Talks are ongoing. We'll keep you updated on any developments on this potential labor dispute.
This is one of those dips that probably gets bought. I mean, the stock is down $4 on this. It's on a strike. It broke out on Friday. Now you get, giving the whole move back on maybe there's a strike coming. It's never good news, but they find their way through these things. They never last forever. They're short term. I think the 2% pullback in UPS, I think, is a buying opportunity.
Big run up. I mean, this is a really tough chart because everybody excited. We're filling the gap, right? We're getting through that earnings high, nothing but clear skies. But he had a 1, 2, 3, 4, 5, 6-day winning streak. We're not even at Friday's low. Monday's low. We're not even in Monday's low at 178.18. So I'd be the first right now as we speak. That'd be the first area I'd be looking at. And if it doesn't get down there early in the session, then you're gonna have to buy. You probably have to buy this thing into a rising market. The close right up near the high at 183.77. I mean, this is kind of a messy chart, but you want to see a clean chart. Look at the FDX here. If you're an FDX trader here, fellow, and I know this news is related to UPS,
Yeah.
but you've had a nice run up here, and you got a what is this, a triple top going? Basically, you got a big area. That means a big institution or institutions is parceling out. So it's just called 250. The actual high of the move was made in July at 250.08. But keep your eye on 250, and FDX. That's a huge number.
It's just been a big move for FDX. And I mean, this thing, and I'm kicking myself here because I thought a couple times about buying this at 160 in the long-term portfolio just because of the value that's there. And now it's 250, and you're like, man, sometimes you just got to not worry about saving yourself a buck or two on these long-term, great buys and great companies and just striking. I wonder UPS, and again, we're not nearly off, the highs like we were in FedEx 233, 180, but you just wonder if this just isn't a long-term buy.
I see. I look at more of a trading range stock. I mean, you talk about great companies and great charts and Apple, but look at this. This stock is basically below where it was in early 2018. So there's been good dips to buying it, but it hasn't been like one of your stalwarts, right? That, I mean, it obviously peaked during COVID or post COVID in 21 when everyone was getting everything delivered still. But yeah, just keep in mind that, if you've been in this thing since early 2018, you're basically flat. And if you didn't sell that when the gravy was on the gravy trade in 21, boom, you sat out a big ride to 22. But overall, just not a great performer, in my opinion.
And sometimes in taking it back to the FedEx, sometimes it's just a matter of valuation. And I actually played this one very well. I had bought the stock. Man, I got to go back.
Long time ago.
Long time ago, in like 2013, probably 2015. And the stock was $90. And, it was just value. It was trading 9 or 10 times earnings back then. I'm like, it's just too cheap. And then it just expanded and it kept going. And at a certain point in time, I don't know where FedEx trades now, but at a certain point in time, I think it was over 20 times earnings. So it expanded a lot. Now it's kind of in the middle of 14. Sometimes just on these long-term, and put your long-term, forget about the chart, forget about your trading glasses. When you put your long-term glasses, sometimes it's just about buying good companies at reasonable valuations and selling them when their valuations get stretched. And I mean, that's what worked for me for Apple. Obviously, the sale hasn't materialized yet, but, I was buying that at 11 times earnings, 12 times earnings. MasterCard was a cheap one too. It's just continued to grow and, it's continued to expand the multiple, but FedEx as well. So, I mean, when it got to $300, it's trading 20 times earnings. You're just like, maybe it's just a little bit too much. So then it gets back down to 140. It's get back down to 12 or 11 times earnings. You got to start striking. When these stocks, these good companies, get down to 11 or 12 times earnings, they're historically buys. It's the same as the market. Historically speaking on the S&Ps, when you get down that 12, 13, 14 times earnings, it's historically more of a buy range. And when you're up at 21, 22, 23 times earnings, it's historically more of a sell range. And that's the waves, and you start going, in the peak bubble, I think the S&P back in the tech bubble was like 28 or 29 times earnings. It got silly. The COVID bubble, it got up 25, 26. It got silly. So if you just take and, PEs do matter. Again, when the story is hot, it doesn't matter at all. But overall in the market, there's no story there, and again, drives price, FOMO drives price as well. But I think that's how you got to approach the long-term investing, as more from a valuation standpoint and keeping an eye on those long-term multiples. Right now, we're 21 times, I think, on the S&P. We're historically expensive here. So just keep that in mind when you're loading up stocks in your long-term portfolio.
I tried to not argue, but discuss this with you and stuff when we were back at the lower end of the move. And I was like, to myself, is the market accepting a higher multiple on the S&P? Like when we were talking about it in like 16, 17, 18, and it's like, well, what's the reason? Earnings are probably going to come down a little bit, but it seems like these days, I mean, obviously in COVID and stuff, but I don't know. Yeah, and you've actually reset your expectation. I mean, you're still trying to buy stocks, that are close to the multiple. But I think I've even noticed you in some of these stocks. You're like, like Airbnb. I mean, that's really, that's still pretty expensive. I don't know. It just seems like there's over the
Yeah,
last year and a half, 2.5, there's been like a little reset. Like we're not going to 12. We're not going to 11. We're not going to get down on that. At least the market's been accepting of that and buying things at a higher relative valuation.
I think you've got to and again, we'll bring Mitch in this conversation here too, but I think it's about understanding the potential for growth too and looking at that as well. I mean, Airbnb is a company that's grown earnings at 40%. It's not going to continue to do that. There's no way they can continue. My buddy Capel pointing that out to me on Twitter. There's no way it could continue to grow earnings at 40%. It would take over the entire, hotel industry, where it would just be Airbnb. So that growth we know is going to slow. They're projecting it, to slow as much to 15%. But even if you project that out, okay, forward multiple on this 36 times, definitely not a cheap stock, but still growing. It's not like it's 3 times, 3%, 5%, 7% growth, 15% growth. It's still significant there. And is there that opportunity to expand into other stuff? Maybe Airbnb this, or, there may be there. So there's an argument that this is not super expensive, but it's definitely not cheap. And you got to pay a little bit for growth. Now, AMD, at 30 times, when I was buying it at 30 times, it's 40 times now. So obviously it's moved a long ways. But, I think there's, huge possibilities that this can continue to grow substantially. If you go into your trusty Benzinga Pro, the 1 year growth rate on this is 43%. It's not going to keep cooking at 40 either, but it could cook at 30. And I mean, at 30, you're buying something 30 times earnings, 30% growth rate. You would be shocked how quickly that PE starts to come down when that growth rate is that high. It's why Apple, back in like 2007, 2008, 2009, when the iPhone was just coming out, Apple was growing so much. The stock price couldn't keep up with the growth. There was just so much growth happening there. And, this is what people are arguing in NVIDIA when they're paying, 50 times earnings or 60 times earnings. They're arguing that the growth is not going to keep up. So there is a time and a place in certain, real growth industries where you can pay a higher multiple, but it's still overall, you've got to, respect. If your company is growing slowly, you don't want to be paying 20 times. I mean, Microsoft at 30 times earnings. What's the growth rate on Microsoft here? I'm just looking, 17%. So it's significant. What's 1 year as well. So big company. I don't know if it continues to grow there. Apple might be a good exercise too. Again, just going to the Benzinga Pro and you can grab these numbers. Apple's revenue growth over 1 year is only 7%. EPS growth 8%. You're paying 30 times earnings. Pretty darn close anyways if I go grab it. 29 times forward earnings, 32 times current earnings for 7% growth. Sounds kind of crazy, but a lot of people predict that there's going to be different, revenues and different, avenues for Apple to continue to grow and get into different, industries, almost like the AI growth there. But there's definitely, some value in looking at your growth rates and looking at your multiples together.
All right, let's move over. Meanwhile, Wolfspeed shares are trading higher after announcing a 10-year supply deal with Renesas Electronics Corporation for silicon carbide wafers. So, of course, that's going to affect the kind of things that you need for certain semiconductors. Also, should affect some solar names. But, of course, keep your eyes out. This Wolf getting a nice little lift. This is not a stock that I've traded often, so I'll kick it to you guys.
What a move.
What a move.
Boy,
The Wolf's out.
Triple D, I'll let you fire.
This is a smaller stock. It's
have you ever traded this one? I don't trade this one.
I have, but it's a huge move off of this deal. I don't know. I don't follow the company's fundamentals whatsoever, so I can't say how much this is going to add in revenue here, but it just seems like up 16% for a deal with silicon carbide wafer supply deal with Renesas Electric Company. This isn't Apple or Amazon.
I know. That's what I said.
I'm like, I don't know. Maybe this company's bigger than we know, this deal, but I'm like, holy, this seems way overdone. Again, stocks get way overdone though, and it was sleepy and it was setting up technically well. So So you do have, traders who are probably positioned in here, but man, this seems like an overshoot.
I think the way you have to look at this one, I haven't been active in it either. I don't even think I've ever traded or even looked at it. Like, what would be your expectations if you were long the stock and you had a target today, and you're like, man, I hope there's some good news on this thing. And just when I look at the chart, to me, like anything over 65 here, really 65 to like 67 and a half, that would be like gravy, in the short term, unless it's just going to be an absolute runner and people are going to be doing deals on this. I absolutely wouldn't be buying it up on $9. And if I was looking at early in the session, I'd say, can it get to that 66.99? That's a buck away. That would be a nice target, of course, when you take out the pre-market high. But big move on just some news, a contract, a company that we're not very familiar with. So if you got a target in the 65 to 67 area, I'd be looking at it today because that's where it is.
Jake
All right.
and Brat talking about the short interest very high in the stock too.
Is
so
it?
that could be another driver. Yeah. And again, this is always a moving target, so it's hard to get this exact number because some of the data is collected over and it's 2 weeks, and some places it can get it faster. I mean, it's just a moving target because there's people continuously shorting the stock and continuously buying the stock. So it's always a moving target. Jake's saying it's 24%. Brad's saying it's 15%. In any regard here, it sounds like it has some short interest, which might be the driver here as well.
All right. Now, I do want to state here that Wolf did get a investment just recently on June 26th. It received a $1.25 billion investment led by Apollo. So if you're looking at what could potentially be kind of helping it also, that one came in on June 26th, really got it started. And then now a nice little supply deal getting it going here. So we'll see what happens here in Wolfspeed Inc. All right, let's move over. Let's talk a little bit about something that's more macro related, but also going to be affecting some semiconductor. The chat already mentioning it. Let's get to it. The breaking news, of course, coming from China as the government announcing new regulations for the exports of two metals used in computer chips, solar panels, and even military applications. Of course, buyers of gallium and germanium will now be required to apply for export permits starting from August 1st. So China currently produces the significant portion of the world's gallium. And now, of course, this is going to have different implications for various industries globally. China fighting back. And I feel like this is something definitely to pay attention to because we keep battling on their side. Now they're actually starting to have regulations against us.
Holy. So do we know what companies this impacts?
Yeah, that was what
I don't know nothing about gallium or
anything that has computer chips, solar panels, or military applications. So all semiconductors, essentially.
They're not really responding much in the pre-market because they're not down any more than their betas. Nvidia's down 0.9% with QQQ down 0.59%. That's almost an under. AMD got an upgrade today, so it's actually trading higher here.
Yeah.
Some of the other chips are down slightly here. The SMH, if you want to grab them all, is down 0.7%, but that's right on. That's actually under what you would think with the beta. Usually it's almost 2 to 1 lately. And we're only seeing it not even down twice as much as the market here. So the market's definitely shrugging off this headline if it cares at all. I would just say, chips are still getting bought on dips here. You have analysts, just take the AMD, for instance, gets the dip and then the upgrades start. I mean, the problem is that, it's positioning by the analysts themselves, and analysts, whether you like them, whether you think they're all idiots, whether you think they're all awesome, it doesn't matter. They drive price. Analyst action drives price. It can change narrative. It can drive narrative. It can keep stocks going for a lot longer than they deserve to go. I mean, there's been a lot of NVIDIA upgrades that just keep pushing the price higher here. So it's hard to be bearish NVIDIA above 400. It's hard to be bearish a lot of these chips as long as they're trading, and that they're still holding their overall uptrends here. So as long as they're still trending higher here, it's hard to just think that this chip rally is over.
What was the day that we got the stock got submarined off of some news it was last week. It was the 27th, I believe. We closed at 418.76. opened at 406.60, bottomed right just above the
Yeah, it was the
previous day.
Biden
Yeah,
administration
yeah.
saying that they were going to put potential, and this was from the Wall Street Journal, and we talked about the
Incredible.
language. We talked about the language in that, which is why it was a buying opportunity. It's like contemplating, or was saying, thinking about, basically. There was nothing imminent happening here, and that's why we felt like, when they were selling Nvidia off 15 points in the pre-market, it was an overshoot, and it was an absolute buying opportunity.
And that's when AMD put in that quad bottom. Remember, it was trading underneath that level in the pre-market. Never saw it in the regular session. Actually opened up right at that area. Now you get the upgrade. I just did some quick math on this one. If you got a target here in AMD, you bought it off the good technical formation as well as a gap fill from earnings. Halfway back here is 119.5, 120. You have a daily high right in that area too, 119, 119.19. But using the news there to good buy the dip after a gap fill AMD. Nvidia's kind of all over the place, but that rebounded strongly as well. And what else would fall? Like LRCX, would that fall into this category? Wow, look at that.
They all.
All
There's
right.
so many
So
tips. They were all down. They all
what we
got
should
bought.
also look at, of course, is the material suppliers like MP and
Spinner bringing
lithium
that up.
suppliers. And that's what you should be looking at. Not necessarily only just, right, the semiconductors that use it, but the people that actually make the underlying assets here. And just a kind of correction here, just wanted to definitely correct there. It's gallium and germanium, of course, but pay attention to that. I would look deeper into each semiconductor company to see how much they use. But of course, just knowing that China has the majority of this is why they're holding it back, right? They hold about 80% of the market. So of course, they know where to hit us. So I think this is something bigger in the long run that we need to pay attention to. It might not affect semiconductors now, but in the long run, I think this is definitely going to be some headwinds.
Yeah, but how much is really going to happen here again, too? I mean, this is all just, U.S. is threatening to do this.
I mean, if they attack Taiwan, there you go. Boom, boom.
That's a whole different argument here, though. I mean, when the day they invade Taiwan, and
We're
Mitch,
toast.
we have argued this point before.
Yeah.
The day China invades Taiwan, you are going to see the biggest sell-off in the markets that we have seen in a decade. The day that happens, the markets are gapping down. The S&P is gapping down 5% that day. I'm not joking. That you're going to see chips. You're going to see Apple down 8, 9, 10%. And you're going to be like, what is going on? That day that happens, the markets implode. We don't know if that's going to happen. We've talked about this for a year now, and it hasn't obviously happened. Elon Musk thinks it's going to happen. I think it eventually is going to happen too, which probably keeps me definitely out of China stocks, because you think Apple sell-off's going to be bad. Your Alibaba sell-off's going down 40% that day. I mean, it's going to be insane how much stocks will go down if China does indeed invade Taiwan. It will be insane. But that we don't know if that's going to happen. So, we think it might happen. There's definitely a non-zero probability that could happen. But, putting a probability on it really is impossible. We can just say it's non-zero. And it keeps me out of China. I would own right now, I would be long LA. If we didn't have any risk of invasion Taiwan, I would be long Alibaba. I would be long FXI probably. I would be long probably Baidu. I would be long JD. But I'm scared to own any of these things because of that probability. But, tariffs and different things is a lot different than invading Taiwan.
Yellen's going there over there too. So
yeah, Yellen's
so that's
we'll
let's play nice. We'll see. Both ends of the
right?
stick,
I mean, that's something definitely that we need to keep our eyes on. We'll see if that expands or not from China and actually hits the stocks. Let's go over.
It's a risk. There's a risk there.
There's definitely something to keep an eye out for. Let's get to our guest segment today. You guys out there, smash the like.
Happy 4th of July, David. The day after. How you doing?
I'm doing great. How are you guys doing?
We're doing good. So we usually get you on like right after earnings season and get your evaluation. We little bit of a lull here. But why don't you put a bow on Q1? I think a lot better than a lot of people expected, right? I don't know if that was off lower expectations, and give us a sneak preview into Q2.
I think you're right. Numbers came down a lot. So again, you're right. They beat sort of a lower hurdle. And I think that's kind of a game Wall Street plays. But I think the big story coming out of Q1 is just the amount of liquidity that was injected in the economy. A lot of it related to the banking crisis. And because the Fed recognizing that the sort of tightness in lending that's going to inevitably come out of the banks, having a scare there is additional tightening in general. And I think they more than compensated by ensuring that there is plenty of money from a fiscal and a monetary perspective in the economy. And I think that's a big part of what drove the rally we saw here at the end of the second quarter. And I think the big question for the second half of the year is how much liquidity they're going to continue to pour in. Because if they start to tighten, I think we're going to see a major comeback in a lot of these names, especially the high flyers like NVIDIA and the zombie stocks. And so I think that's it. I think the Fed continues to try to walk a very fine line. They want to rein in some of this excessive spending without bringing things to a crashing halt. And it's hard to know if they can do both.
I mean, the economy thinks they can do both. Stock market, well, not the economy, the stock market thinks they can do both. I'm not sure that I've, been in that camp, but right now the stock market's fully getting driven by FOMO. And I mean, what changes the narratives? Because we can worry about all these things that David, me and you and, Mitch and a lot of us were worrying about for the last year. And, none of these risks, the stock, and some of the stuff has started to show up. The stock market still doesn't seem to care. When does the stock market actually start caring about higher rates? When does it actually start caring that, hey, maybe, there isn't going to be a soft landing, or maybe there is? When does the stock market actually start to care about the Fed?
Yeah, if I had that answer, we'd be doing this on my jet, right? I mean, I think the Fed would like to know that too. And, and Dennis, I also feel like the stock market is really driven very differently than it was in the past. There's the old sort of lead steers analogy where you got a kind of bunch of big money folks that kind of lead the market. And I think that has been debunked for a while, but I think more than ever, right? I think especially with order flow, I think it's the retail constituents, the retail self-directed folks mostly driving the market for mainly one reason. The institutions with payment for order flow and other things, they know where the market's going to go or when the retail folks are going to change their mind before the retail folks know their minds have been changed because they're seeing that order flow. So I think what that means, and we definitely see this manifested with particular stocks, what that means is that you can have significant dislocations for extended periods of time because the folks that know enough to understand that it's really a dislocation can trade out of it before it rectifies because they got the order flow. So I think it's going to be difficult to change that narrative because I think there's a lot of self-directed folks who like FOMO. It's been good to them. And I don't know what it's going to take to rattle their cage enough for them to say, you know what, it's over. Because I don't think they ever want it to be over.
I mean, most of the crypto story, and move Bitcoin aside, maybe Ethereum aside, but there's, 1,000 coins or more than that are all just driven by a story with no fundamentals whatsoever and all driven by FOMO. And I mean, yes, a lot of that market crashed and burned, but some of it's still holding up. I mean, it's like, people, maybe even I believe that some of these investors and some of these coins kind of know they're fundamentally worthless, but that they think that they're going to be able to get out in time from, another person that's just willing to pay more. So, I mean, the FOMO in the crypto markets, has, kind of went down, but still there. So, I mean, you've almost got to get the FOMO out of that stuff before it even starts to go into, equity markets, which actually do have some fundamental value at some point in time.
I agree with you. I think it's got to be a gradual, and that's the goal, I think, for the Fed, for it to be a gradual process, for the sort of slowly choke it out of the market. And I think and you never know where it's going to hit first. I mean, earlier this year, we saw it hit with some recklessly run banks. I think it would make sense for the crypto to be a next spot just because that's where speculation is the most ridiculous. And then there's plenty of places in the stock market where you've seen the exact same pattern, Dennis, where stocks that were ridiculously high flying, it came down 80, 90%, and then went on another run. Carvana, Beyond Meat, Robinhood, some of these Peloton. And you just wonder, okay, well, when will they come back to earth, and how can they continue to defy gravity? And that's the question of our time.
We're on the line with David Trainer of New Constructs. David, what would you say to the investor or the person that said, you know what, the Fed really hasn't done much this year, just because of what you alluded to earlier, that, with the banking crisis, they still pump plenty of liquidity into this market. Yeah, they've raised rates, but, maybe we're just standing still here. I mean, just going off your earlier point, I mean, really, has there been that much monetary tightening going on?
In terms of quantitative tightening, I think that there's been more bluster than there has been action. And yeah, I think they had to sort of pull off in the first half of this year because of the banking crisis, and they've done. I mean, rates have come up a lot, but has it been that impactful? It's hard to say for sure. I mean, there's a lot of folks that believe that maybe the Fed has overdone it because there's such a long lag between the rise in rates and the actual decline in the economy, or the impact of that rise in rates. And nobody knows for sure, right? When the Fed says they're data dependent, I think what they're trying to say is that we're not sure. We're trying to see how things unfold, and I don't have the answer to that. I do think things feel a little bit tighter at times. And then we have runs like we saw in June, where things go from ridiculous to more ridiculous, and so I think that this is part of the inevitable. I feel like slow and gradual tightening. So I kind of believe in a narrative, like I mentioned before, that as opposed to maybe historical Fed regimes where they came in and just started chopping off heads, in terms of raising rates and bringing things to a crashing halt. I think this regime is looking to try and do it a little more gradually, let the process take a lot longer. And I think, to Dennis's point about FOMO and how much they like it, retail investors like it, the only way to cure someone of something like that is to make it not work for a long period of time. Otherwise, it's buy the dip. And I think the distinguishing change in behavior that we're looking to achieve here is that people become discerning about where they allocate capital. They're not just chasing returns for the sake of returns. And that's a long-term habit.
Now, one thing that we just saw as of recent, of course, the IWM starting to come up, some small cap names starting to trickle their way higher. One thing that I'm focusing on is, will these zombie companies ever come right back down? I mean, ARKK starting to really get the lift, growth stock starting to push. I was in that camp for a while there. Carvana to zero, Affirm to zero. I have flipped, of course, and started to be like, well, just doesn't look like the cash burn matters here, because it came down, but we quickly see how it gets picked back up from the FOMO buyers.
Yeah, no, I mean, that's kind of back to what we said before, Mitch. I mean, it doesn't make a lot of sense, and it just makes no sense, and it continues to do that for a while. It's sort of think we feel like that. Yeah, you can be nonsensical, but that can't last. And as it lasts, you're forced to capitulate in the way that you have. I mean, I remember back in the tech bubble days, colleagues of mine early in the tech bubble who sort of were resoundingly, hey, this is nuts. We're not going to do this. I'm not going to fall for it. Yeah. And after a few months or a year or so, I don't remember how long it was, I remember they would sort of come to me like a confessional and say, yeah, David, I want you to know I bought some of these stocks. I feel bad about it, but, I believe in the greater fool theory.
FOMO is real, and FOMO is in everyone. It's not just retail. It is in human nature. FOMO is real. I fight FOMO myself, and like sometimes you just gotta, just say, yeah, this doesn't make sense. I'm just going to ignore it. It's better just take it off your screen as opposed to, do something dumb. David, there is some opportunities here, though, and maybe we should talk about that, because we can talk about, the markets, tech stocks being overbought or potentially pulling back here. But there are definitely other opportunities here. There's not, this crazy, bull market and everything. The IWM has underperformed massively here. There's a lot of components of that are sitting near 52-week lows or not far from it. The banking sector has been an absolute disaster. Is there anything you're looking at from a value perspective right now that there's an opportunity to actually buy stocks at reasonable valuations?
Yeah, I'm pleased to say the answer is yes. We think that there's a lot of opportunity in basic materials, energy, and financials. We've recently written up some ideas around firms like Steel Dynamics, Nucor, a really interesting company called Warrior Met Coal.
What's that symbol on that one?
HCC. And what we like about that is that most people just throw all the coal companies out with the bathwater because they think it's just bad for the environment. It's part of this ESG greenwashing, and Warrior Met produces a very particular type of coal called metallurgical coal, as opposed to the thermal coal, which is bad for the atmosphere and is used to create electricity and heat. Metallurgical coal is used to create steel, and the demand for steel is going to be driven, interestingly enough, by the demand for ESG equipment. So wind turbines and solar panels all require a bunch of steel. In addition to that, you've got huge spending on infrastructure in the United States. It's going to drive demand for steel. So we think this Warrior Met Coal company it's trading as if its profits will permanently decline by like 80%. So the price implies it's going to go out of business, and we think that demand is going to be strong for a while. So that's an interesting play where people, I think, got the wrong kind of coal in mind.
What about some of these other energy stocks too? Sorry, Joel. What about some of these other energy stocks? I mean, you've got valuations which are depressed because oil prices have, gone down significantly from where they were. I mean, not, as much as, obviously where we were a couple of years ago, but we're off the high significantly here. Do you think there's other value here in other energy plays?
Yeah. I mean, we like a lot of the major energy players, Shell, Total, even Exxon's starting to look good these days. We think that those are great businesses. And when you do the research, you do the math on that too. I think we even heard the CEO at the Aspen Ideas Festival last week or a couple of weeks ago. I don't remember which one it was, but he made the point that, look, the demand for energy is growing faster than the supply of alternative energies. So fossil fuels demand is not actually expected to go down much at all over the next 50 years. And that comes from the International Energy Association. So the idea that all these energy companies are just going to be going out of business, it's going to be terrible, is unlikely. Secondly, we feel like the distribution capability of these big majors is really strong. And so as they diversify into alternative sources of energy, they're going to continue to do really well because whatever they're pumping through the system, they're going to be able to make a profit. We like a lot of those companies too.
David, before we let you go, I'd like you to comment on one thing that we were discussing earlier, and that was historical valuations in the market, right? Going back over history, 10, 11, 12, 13, 13 PE has been the spot. It's been the sweet spot. If you were waiting for that on the recent decline in the markets, well, it didn't get there. Of course, some stocks did. Others didn't, some of the growth stocks. But do you think that there's like a reset going on, that there's a higher bar as far as like overall valuation in the S&P, that it's going to be the new 12, 13, going to be 16, 17, 18, something like that? Love to hear your comments.
You can make an argument for that, coming kind of out of the Kathy Wood playbook. I think most of her analysis is misguided, but I think in general, you can say that there's more innovation and more sort of opportunity for those higher valuations in a place like the S&P, because these companies are innovating and creating at a higher rate than they had in the past, and that is a general sort of positive trend in the human race, and we're getting smarter and better at that. But I do think that at this point in time, we're maybe a little ahead of ourselves on that. It's manifest in a few places, but not in all places. And right now, we think most everything is a little bit too expensive, except for some of these stocks we mentioned, where we feel like we found some diamonds in the rough and some safe places. But for the most part, that concept is misguided. It's been around for a long time. This idea of creative destruction and the sort of increasing rate of innovation over time is not a new concept. I think it's been co-opted by some to sort of justify some pretty silly investing. But long term, do we end up being a little bit more expensive than what we were in the beginning of the 20th century and mid 20th century? I think the answer is yes.
David Trainer, founder of newconstructs.com, giving us some excellent fundamental analysis on the markets. David, thanks for joining us. We'll get you back on again soon.
Thank you. Good to see you guys.
All right, let's get back to the market. Let's take a look at how we're doing right now. Are we leaking still, Joel?
I think the market still thinks it's the 4th of July or something. At least since we've began the show, we did make a little dip. Took out the pre-market low. It previous low was 67.50, but we didn't get very far. 66.25. It just feels like things are firming up a little bit out there. Triple D, what are you seeing on your
This
end?
is historically a very slow week. You don't have a lot of earnings. You have a holiday in the middle of the week. You had a half day to start the week here, so it's a 3.5 day. No earnings, a little bit of Fed speak. I mean, if you were a trader and you were looking to take a vacation so that you're in high likelihood not going to miss a lot of action, it's this week that you peg. So I would expect, to be quiet. I would expect, not, maybe get a little bit of chop, but I don't expect, huge moves in either direction. I think we're just having a repricing from what Europe was doing when we were closed. And I don't think, we're going to have this crazy moves. And I don't think there's a lot of catalysts. There is Fed speak. The minutes, obviously, are coming out, 2 o'clock the minutes? Fed minutes?
Yes, sir. 2 o'clock.
Yeah.
So that can be a driver. So 2 o'clock. But after that, so let's get to Thursday and Friday. I think it's going to start to get really quiet. So we're going to have, some fireworks here, maybe at 2 o'clock with what they say. But again, are they going to say anything we don't expect? I would expect the minutes to still show they're being somewhat cautious with inflation, a little bit hawkish, and they're probably going to stay the course where they're looking to raise next meeting and potentially the meeting after as well. So I think the market kind of has the Fed figured out. They're kind of, that's one thing about Powell is he doesn't sugarcoat much and he doesn't really talk cryptic here. Like he kind of tells you what he's thinking and he kind of flat out spells it out for the market, and he really has. I mean, you can say, oh, look what the Fed caused this sell-off back in 2021. Well, I mean, where would inflation be if the Fed wouldn't have started raising rates? So, I mean, he talked about raising rates 3 months before he ever started raising rates. So, I mean, he tells you what he's going to do, and the market trying to figure out, oh, yeah, they're going to change their mind or this or that. I mean, just listen to Fed. Take his word at face value, Powell, his word at face value, because he has not lied very much.
I mean, if you're sitting on pins and needles waiting for the bellwether of the economy, Levi Strauss, they announced earnings on Thursday after the close, and there's no reports today at all. And then the other companies I barely recognize, but I will say there is a potential catalyst on Friday. Of course, the first Friday of every month, we get our non-farm payrolls, the unemployment rate. That hasn't, the CPI has been the number that's been moving things. But if you're looking for a catalyst, a major catalyst, fundamental catalyst besides the Fed speak, then tune in Friday morning when we'll cover the jobs number.
All right, let's go to Netflix here as Goldman Sachs has upgraded Netflix to neutral and raised its price target to $400, citing the company's successful execution of its password sharing initiative and regain momentum in content creation. I do know somebody that's been talking a little bit about this password sharing thing. I'll let him kick it off. What's up, Dennis?
Yeah, I mean, again, this is the driver of price here. I do believe subscriber numbers are going to go up because people aren't ripping off from their friends as much anymore. So it was a good call for them to grab more to stop the password sharing, to drive subscriber growth numbers. And I think you're going to see that in the numbers. And I think that's going to be a major driver going forward. It's like, holy cow, look at all the subscribers they picked up. Yeah, because it was half the people were just ripping it off of their friends. So I think the Netflix is a buy on dips. I've continued to be bullish this for a while. Sold my stock way too soon. Thought about rebuying it at 320. Obviously should have. And now, I look at it at 440 and think, wow, I missed the boat. And holy cow, did Ackman screw this one up.
Yeah, man.
Oh, yeah. Dennis, when you did buy it, and I remember, do you remember how low the valuation got
Got down to
on it?
16 or 17 times.
16 or 17, yeah.
And again, so again, this is the way I approach my long-term buys is like I buy good companies at reasonable valuations. The Netflix valuation got the most reasonable I think it's ever been. I don't think it's ever traded.
by far.
I don't think it's ever traded 15 or 16 times earnings. And where is it now? So if we bring it up here, the reason I sold it again at 310 or 320 when I sold it was because the PE expanded to 29. The stock doubled. So now it's 38 times. So, I mean, are the numbers going to be good? Yeah, I think that PE actually forward PE, it's 47 current, 38 forward. I wouldn't be surprised it's only 35 times here because I think you're going to see the subscriber numbers go up. But, again, the multiples just expanded. So, that's when, Meta, it was the same story. And, obviously we should have all bought Meta back when it was $90, but the thing got down to 12 times earnings, 11 times earnings. So it might have even been less than that.
Let's stay with Netflix outlook too, and what really affected it, right? Well, what knocked it down? It started losing subscribers, right? And then that really kind of brought that downturn.
Good people.
And then what brought it back up? Well, it just started getting the subscribers back. The ad tier got it going right back to the upside. And now I've heard mentions that they're even taking away the lower tier of Netflix to try to get a little bit more money. I saw that from a mention from Canada's Netflix. So that probably shifting over to the US pretty soon, where the lower tier might go away and you have like this higher tier, or you have the ad tier. So one thing also to look at was Netflix for a while there was starting to lose momentum on content creation. Everyone was starting to talk about the different kind of availability that was out there. Disney Plus was starting to go, right? You had Discovery Plus, you had HBO Max. The truth is, none of them do content like Netflix. Let's stop thinking that any of them can do content like Netflix.
Yeah.
Because the truth is, they cannot. They cannot compete at the content level that Netflix has.
I would say Disney does just as good a content, but they don't do enough of it. So, and this is with my argument, they needed to put more resources into Disney Plus because they can produce really awesome content. So I do believe Disney can create superior content than Netflix, but they just don't have any. I go on Disney Plus and there's nothing new to watch ever. They get a new Star Wars series every once in a while. Half of those sucked. So, I mean, maybe they're trying to pound them out and they're trying to pound them out too fast. Andor was pretty good. The Luke Skywalker or the Anakin Skywalker series was pretty good. But, I mean, overall, it was kind of disappointing. The Mandalorian, the first season was awesome. And the second season and the third season sucked. So, I mean, I guess, maybe they're trying to go and they're trying to get the content out faster. And it's maybe, making it a little bit more inferior. But Netflix is always something new to watch. They just need, if Disney really is serious about streaming, they need to put more resources to it and start getting more content on there, because otherwise they're going to lose subscriber numbers in that Disney Plus.
And the big thing there is Disney said what when Iger came back? He said that no, they would spend less on content, and I already said that was a bad news there. That's not good news that they want to spend less on their content.
They need content on that Disney Plus or they're going to lose subscribers. If you want to put that much money into developing the product, you've got to feed it content, new content all the time. We talked about this 2 years ago. Disney, if you're listening, get some new content on there. It's just not enough. Even if some of it's not that great, give us something to try to watch. Half the Netflix stuff sucks. Let's be honest here. Half of it's really crappy. But you know what? There's always something new to try. And, it's like they throw the crap against the wall and see what sticks. There's so much stuff on Netflix. There's always, a dozen new shows, I feel like, every day. So we need content. That's what these things need. And that's what they don't have. And that's what Netflix is fantastic at, is producing quantities of content, even if some of the quality isn't that great.
Something new to watch. High of the move in Netflix. If you've been waiting for that, it's 445.27. You did get over it a little bit in the pre-market trading. Keep an eye on that. If you're more focused on daily highs and the high of the move, 448.65 is the high of the move. And second high is 47.51. So coming up on some potential resistance. Also, I looked at this one, how we've had a lot of these big stocks take back over half of their move and get back near all-time highs, make new all-time highs like Microsoft. This one, the halfway back is 432. So it's already taken back half of this move. And let's see if it can build another base here and move higher. Next monthly high comes in at 458. S&Ps, I'm just going to wrap things up here on my end.
Sure.
Just kind of a quiet morning here. We're down, but not out. Let's see if we hold that pre-market low at 66 and a quarter. That was right near the interday low from Friday. So found some good things to talk about on this Wednesday here, a holiday week. Everyone, have a great trading day. We'll be back with you later on.
I'm going to hop as well here, so we'll leave it up to Money Mitch here. We'll be back at you tomorrow. I'd expect some movement at 2 o'clock, and then I'd expect quiet markets I would expect quiet markets for Thursday and Friday as we're really into this holiday week here.
All right, we'll see what happens. Like always, you guys can keep up with Dennis, Dick, and of course, Joel Elconin on PreMarket Prep Plus and Dennis Dick, Triple D Trader on Twitter. Give them a nice follow. I'm going to get you guys over to, of course, some trading action. That's coming up next. Live trading. Yes, we got it back, team. We're going to be all back there. I think Ryan right now is traveling to the headquarters, but I should have Zunaid in the chat, so definitely stick around, team. Don't go anywhere. Got some live trading coming up next. And of course, we'll get some more for you guys. I did want to wrap up some of the news items of the day. So we got a couple more to just really quickly run through. Of course, AMD did get an upgrade today from Northern Capital. So Northern Capital Markets giving a little bit of an upgrade. We'll see if AMD can keep running today. We'll see what happens there. An interesting one for me is initiating coverage, Jeffries, on Hertz. This is one that I've been watching. I've been talking about how Avis budget started getting going. That was, of course, car. You guys can see how that started to move. I'm taking a look now at HTZ to see if this could really get going. I know that this seems like a little bit of a stretch, but with this mention, a price target of 24, I'm going to look to see if Hertz can get a little bit of some squeeze action today. We'll find out about that one. Citigroup did upgrade Rig Transocean to buy. So if you guys are looking at shipping stocks, this one looks interesting to me. Definitely on a trend line break. You can see how this broke right here. So I'd be looking for pullbacks closer to 7, but we've already taken off from there. Next spot on the highs is closer towards 764s. We'll look to see if Rig can keep moving to the upside. And like always, team, stick right here. That's going to wrap it up for today's market outlook. We covered a range of topics from the Federal Reserve minutes and speeches to regulatory change in China and significant developments in various companies. Stay tuned to PreMarket Prep, of course, for further updates. And remember to make informed investment decisions. We'll see you next time right here on PreMarket Prep, the #1 morning show to get you ready for your trading day. Hit the like button now to get you over to live trading. That's coming up next. Don't go anywhere.